Good day, everyone. My name is Adekemi Omotubora, and I'm a lecturer at the University of Lagos. My research focuses on the intersections of law and emerging technologies, and I'm particularly interested in the governance, gender, and equality and inclusion aspects of artificial intelligence. So today my presentation is on AI and gender. It's titled AI for Women's Financial Inclusion, Analysis of Products, Design, and Policy Approaches in Nigeria. For the Data and Policy Conference 2024, my submission number is DAP-2023-0144.R. So this research aims to understand how AI is used for financial services in Nigeria and its prospects for women's financial inclusion. So if I can just give some background, globally, there's a significant gender gap in access to financial services, as women have historically been less financially included than men. According to the World Bank, in fact, 56% of those without a bank account as at 2021 are women. But in Nigeria, the problem is more significant. Nigeria has one of the widest gap in gender financial inclusion in the world. Statistics dating back from 2019 shows, for example, that 31% of women have a formal account compared with 61% of men. Recent statistics have indicated that Nigerian women are still 12 percentage points less likely than men to be financially included. So the overall projection is that this gap will persist if there are no interventions and radical interventions in terms of innovation, policy, and regulation. So we can just look at the figures here to gain some insights into women financial inclusion. If you look at serial numbers 2 and 5, we can see how there has been relatively a lack of progress in women's financial inclusion over a period of 12 years. So we see that 57% of women that is of 41.5% of 41.5 million women. That's about 23.6 million women were excluded in 2008. If we compare that to 40% of 53.3 million in 2020, that's about 21.3 million women in 2020 are financially excluded. So one conclusion that we can draw is that there has been no significant increase in the numbers over a period of 12 years. And the number of financially excluded women appears to have held steady. In fact, it rose consistently with the population. So there's no indication that more women are using financial services, even as their population has increased. So other or additional inferences that we can draw here is that policy approaches to women and in fact, overall financial inclusion may be ineffective. Nigeria started developing its financial inclusion strategy in 2010. That did not seem to improve things. It was improved, it was reviewed. And then subsequently, other frameworks were introduced. There's the Framework for Advancing Women's Financial Inclusion in Nigeria, introduced in 2020. There's a framework on digital financial services awareness, which was proposed in July 2022. And there's the National Financial Strategy, there's the National Financial Technology Strategy, which was released in November 2022. So we can argue that given that some of these policies are still relatively new, they underline both the shortcomings of previous policies, but at the same time, they make an assessment of progress or policy achievements on women financial inclusion difficult. What has remained, or what is significant, is that financial inclusions remain pivotal to women's economic empowerment. It helps to foster better agency and decision-making for women, and it's also critical to overcoming gender inequality in a broader sense. And also of particular significance to a country like Nigeria is the role that financial inclusion plays in reducing women's poverty. It's common for us to hear, things like women are the face of poverty, but that I dare say applies to Nigeria, applies to Africa and globally, because women tend to be poorer than men. And this can usually be because of cultural reasons. There can be reduced economic opportunities, limited access to education. So financial inclusion, when we look at it in this sense, can actually create a vicious cycle of poverty. The less access to financial services women have, the more likely they are to be poor. And the reverse is also correct, that the poor women are less likely to access financial services. And this is even also significant if we consider it from the broader context of access to credit, rather than from the narrower sense of access to savings and payment. So when it comes to access to credit, they are more dependent on traditional documentation requirements, the use of collaterals for accessing credit worthiness. So the stakes are really high in a country like Nigeria, where more than 87 million people live in extreme poverty already, and about 43 million of these numbers are women. So research and literature and the increasing innovation have shown that fintech, particularly when they are powered by AI, can reduce women's financial exclusion. AI in particular provides insights into customer needs. They allow providers to customize and personalize financial services and even credit decision making. There are credit scoring algorithms that can be used to facilitate access to credit. And these algorithms can eliminate credit scoring biases because they can generate and they use alternative data streams, such as the digital footprints of the users for financial decision making. So we can look at personalized services as a means of addressing the needs of respective user groups, communities, and excluded demographics like women. So here, what I've done is simply to provide a brief outline of the problems, the questions, methodology, and the findings from this research. So past policy innovations, the problem aspect of it is that past policies, innovations in fintech have not significantly improved women's financial inclusion. And the question is, how can we effectively address the challenges of women financial exclusion in Nigeria? And the methodology that is used is to survey service providers to find out what service is available, how they are using AI, who's the target and potential users of the services they are providing, and the findings or conclusions that are reached, which I would mention again later towards the end of the presentation, is that it's unclear whether and how AI is used by fintech service providers. Products may not be targeting excluded demographics. The new the innovations in financial technologies In fact, it looks or appears as if they are not targeting financially excluded women. So the methodology that was adopted is to survey 169 licensed providers in different fintech categories. We examine AI current application in finance using 4 indicators. That's the category of licensed services, AI use in financial products, specific use cases and application, and the location or geographical spread of the service providers. So information on the providers was sourced directly from publicly available information from financial sector regulations, such as Central Bank of Nigeria, the Securities and Exchange Commission, and the website of the providers themselves. And what are the results that we found? So with respect to the first indicator relating to the category of licensed operators, what we're really interested in is how many fintech operators are licensed to provide services that financially excluded women might need. So we find out that out of the 169 licensed operators, 18 are mobile money operators, payment service providers, and super agent authorization. So there are only 18 licenses issued in this category. And that's significant because these are the services that usually, these are providers that usually offer the basic or consumer facing services like access to payment and savings, which financially excluded women may need. So this situation that we have, where we have only limited providers playing in this area, might aggravate what has been referred to as demand and supply related barriers to financial inclusion. So with demand related barriers, women fail to demand or use financial services that are relevant or appropriate to their needs. Sometimes that's due to low income, their cultural constraints, there's lack of trust in providers, and with supply-related barriers, those capture the failure of service providers to offer products that are appropriate and relevant to women. So when existing services fail to meet women's needs, we can say that they exhibit a supply-related barrier. So we can argue in this sense that licensing limited operators for products that women might or do need can aggravate these problems. Providers will not innovate or offer or supply products that meet the needs of financially excluded women, and women will not demand or use products that are supplied to them, which they don't need. So this could create a kind of chicken and egg situation. With respect to the second indicator, the AI use cases, we wanted to find out, what do fintech providers use AI for? What kind of services do they use AI to provide? So our analysis showed that most of the providers, there are 45 of them that claim to use AI, and most of these providers just provide services that optimize already existing financial product. Or they offer sophisticated value-added services such as trading platforms, international money transfers. And the question that is critical here is whether financially excluded women are likely to use this kinds of sophisticated services. So the third indication that we use relates to the number of basic consumer facing providers or providers who offer basic consumer facing products that use AI. How many of them use AI? So we find out that there are 45 providers like I mentioned, who claim to use AI, but only 13 of them provided information on their specific use cases. Only 13 describe how they are using the AI, how it's integrated into their product, and the specific service that is used to provide. Out of that, these 13 providers, only 2 of them are MMOs and 2 are PSSPs. So like I mentioned from the beginning, these are the providers who are likely to offer basic or consumer-facing services like payments and savings. So it's one inference that we can draw from the indicators 2 and 3 is that research suggesting that women who are financially excluded may prefer services that support savings and micro credit. So the research already establishes or has already established that many women who are financially excluded will prefer financial services that support savings and microcredit. An example is a research which shows that 6.3 million unbanked women in Nigeria rely on informal savings collectors and merchants. And an additional inference that we can draw from the indicators 2 and 3 is that if enough providers are not integrating AI into their services, the benefits of AI, like personalizing financial services, cannot be fully annexed. In fact, it could be missed altogether. So the fourth indicator is the geography, location, or geographical spread of the service providers. So we found that most fintech service providers, whether they use AI or not, they are either in or operated from big urban cities in southwest Nigeria. So sometimes these locations are far away from rural communities, from the grassroots, where women are more likely to be financially excluded because of the unavailability of bank branches and other alternative financial service providers. So we might ask, on the one hand, why is location relevant? Because fintech are digitalized. On the other hand, we can make a case for why it is important for service providers to be localized or proximate to those that they serve. So if services are digitalized and they can be offered without geographical boundaries, we might say, well, why do we need that kind of assessment? M-Pesa, for example, is a Kenyan fintech company. Yet it's one of the largest mobile money services across Africa. So again, like I mentioned, there's a case to be made for locating operational offices close to target users. So consumers may be more comfortable with or trust local or proximate service providers. Proximity and familiarity can produce better product sensitization. It can enhance digital financial literacy as providers of these services can better assess the digital and financial literacy needs of their users if they are closer to them. Again, there's research that shows that women are more likely to need support to open accounts and effectively use a bank account or digital financial service. And this particularly so when they are also illiterate. Most illiterate people, for example, they can't do a lot on their phones. They can't access the full benefits of the mobile technologies. They can receive calls. They can answer calls. They can make calls, but oftentimes they can't access the full functionalities of the mobile technology. They can't do contact management or text messages or text messaging. So much less to conduct financial transactions on their phones. So this slide just shows the distribution of licenses across categories and the distribution, geographical distribution of the service providers. And so what are the conclusions that what conclusions did I draw from this research? I mentioned that products may not be they may not be targeting excluded demographics like women. That's one result that we got. And it's unclear really whether and how AI is used by fintech providers, for example, to address developmental needs like financial exclusion. So what role can technology play, can policy play in all of this? So we can develop policies, incentives to promote startups and new business models. We can liberalize licensing requirements for startups for startups that aim to provide basic financial services. Presently, the capital requirements are still quite high, and they may not, these startups may not be able to meet these capital requirements. They have to compete sometimes with more established providers like traditional banks that also want to play in that space, and who can better or easily meet the funding requirements. Sometimes the startups are funded by profit-driven venture capitalists. And so in those cases, there's less incentive to invest in the untested markets for the financially excluded. Incentives can also take the form of tax breaks and exemptions from corporate obligations in order to encourage new startups, designers, developers of financial products and services that serve excluded groups. So we can have a kind of tax break that target this category of providers. And policy can also be used to drive microfinance banks' investment in AI. Microfinance banks already serve women, they serve people living in rural communities, they serve people at the grassroots, and so they can overcome the problems of location, mistrust of the providers, lack of familiarity, and proximity. And one important policy approach is also developing policy and ethical frameworks for responsible AI. Responsible AI already captures inclusive and equitable design of AI. And there's a big conversation, a big and ongoing conversation around responsible AI. And one way that it can help in the context of financial inclusion is to mitigate discrimination in credit outcomes, to support historically marginalized groups like women. So we know, for example, that it's possible to perpetuate unequal access to credit when non-representative data or data that has traditionally or disproportionately captures one gender is used to train credit rating algorithms. So these are policy approaches that we can adopt or work towards presently to address financial inclusion of women, to achieve financial inclusion of women. So one limitation of this research that I'd like to mention is the approach to our understanding of women financial services needs. So we use that broadly and in a way that suggests that we already know what the women's financial services are. Actually, We think that there is need for more empirical work to support existing research in this area, because financial needs and needs generally do evolve. Women are not the only demographic affected by financial exclusion. Women are not a homogeneous group, and there are multiple social identities, there are cultural practices and experiences that can affect access to finance. So, for example, women in some parts of northern Nigeria, women who live in rural areas, those living with disabilities, illiterates, or poor women are more likely to be financially excluded. But we don't have current comprehensive or any form of reliable data on how certain factors shape financial services needs and women's demand for those services. So we need better understanding of how factors like marginal and intersectional identities affect women's financial inclusion in Nigeria. So that's my presentation. Thank you for your time, and see you at the conference.